The budget is basically the P&L of the government. Rather, it's income and expenditure statement. So what are the big numbers to watch for? The biggest number is the fiscal deficit number, but that will depend on the tax growth assumption. So let me start there. This year, the government assumed a tax growth of 8.5%, but it got a bonanza of 25% tax growth because of higher corporate profits, higher GST collections, but it has cut fuel excise duties this year. Hence, next year, the excise collections will be less. Also, given the large corporate base and GST kitty, these may not grow so much. Economists are going with a 10% corporate tax growth and a 6% overall tax growth. Now, let us come to expenditure. In expenditure, the big number to watch is capex. Okay, this year the government has spent a lot of capex, but it is still lower than what the budget said. Also, it's a 25% growth because of the low base. Now, next year, if the government is able to show another 25% growth of, 6.5 lakh crore or 6.6 lakh crore capex, that will be a huge positive. With this, let's come to the big number, the deficit. Most economists are working between 15.75 lakh crore and 17 lakh crore of deficit, largely around the 16 lakh crore number. That is, they are working with a 6 to 6.3% fiscal deficit as a percentage of GDP compared to last year's, that is current year's 6.8. Though of course they may actually do a little less than that. Now, what will this mean by way of market borrowing? The net market borrowing is expected to be pretty similar to this year. This year, the government was working with about a 9 lakh crore of market borrowing, and that may be the number, 9 to 10 lakh crore may be the number. If it is as big as this, it will be negative. If this can be brought down, bond markets are going to be happy. Okay, with these broad numbers, let me get my experts in. We are joined by Soumyakanti Ghosh, Group Chief Economic Advisor, State Bank of India, Abhishek Upadhyay, the Chief Economist at ICRA Securities Primary Dealership, and Aditi Nayar, Principal Economist at ICRA. Well, gentlemen and lady, thank you very much indeed for joining us. Soumya, to begin with you, the big number is going to be the fiscal deficit number. So tell us, what is your fiscal deficit number and how do you expect it to get financed? How much will go from the bond market?
Yeah, thank you, Lata. I think the numbers which you have put out sound similar to the estimates which we are working with. See, this year we are likely to maybe end with a fiscal deficit maybe a little closer to say maybe around 15.6 to 15.7 lakh crores because of the expenditure growth. So now, having said that, next year and this year the nominal GDP growth is 17.6%. So if you are working with a nominal GDP growth rate of 13% next year, that will give you a GDP number of around 262 lakh crores. Now, on these 262 lakh crores, if the 13% is the nominal GDP growth rate, assuming a tax buoyancy which is close to 1, we can safely assuming that the tax growth could be in the range of 10 to 11%. So if I take that as the tax growth, and capital receipts say maybe of around 1.5 lakh crore, we'll be working with some revenue projections, which is basically the tax revenue and the disinvestment receipts of around 21 to 21.5 lakh crores, which is a growth of around 10 to 11% over the revised estimates. And if we are able to contain the expenditure growth rate at below 10%, maybe at 8 to 9%, that will give an expenditure number of around 38 lakh crores. So broadly, the fiscal deficit, which will be the difference between these two, is around 16.5 to 17 lakh crores, which the market maximum can be absorbed. Now, if you ask me about the borrowing numbers, I think here there is a catch. The 17 lakh crores, basically, typically you have to net out the redemption, which next year is around 3.8 lakh crores, and the short-term borrowings. Please note that short-term borrowings in the last 2 years have come to the rescue of the central government because of abundant liquidity, which may not be the case this year. So even if we are assuming that the short-term borrowings, which are basically vacated during the year, around 1 lakh crores, and then redemption of around 4 lakh crores, that means you take out 5 lakh crores from 17 lakh crores of fiscal deficit, which gives you a gross borrowings of 12 lakh crores. And I think that's a reasonable number to go with, because last year also the number was close to this number. But last year, please note that RBI did an OM of 2.6 lakh crores, which may not be present this time.
Okay. Abhishek, I will have to toss the same thing to you. This is a fairly exhaustive explanation from Soumya, though perhaps I'll ask all of you whether the tax assumptions can be as robust this year, given the large base. First, I want to ask you about the fiscal deficit number that you are working with and how you expect it to be financed.
Hi, Lata. Yeah, so the big picture is that fiscal stance should be set in a way that it supports the uneven recovery. There's still large scope for catch-up with pre-pandemic growth trend. But at the same time, as you mentioned, it should be set in a way, the fiscal targets should be set in a way that the borrowing program does not go out and complicate RBI's task of managing the exit from ultra-easy monetary policy settings that are in place currently. We are assuming that fiscal deficit consolidation of roughly 0.5% of GDP will be consistent with the balance that I'm talking about. Even if deficit were to be lower by 0.5%, and we still don't have a starting reference point for this year, because it will depend on factors such as whether LIC disinvestment goes through or not. But broadly working with a 6.6 to 6.8% kind of assumption, and assuming 0.5% decline in deficit, absolute fiscal deficit will still be higher than what was penciled in for, or what is likely this year. Now, to fund that, there are two challenges. Firstly, the benefit from small savings collections, which is likely to accrue this year, it may not be there to at least similar extent next year, because as deposit rates go up, small savings collections should come down. And secondly, as Soumya mentioned, you don't have RBI support next year, which has been significant over the last couple of years. Whereas gross borrowing program of close to 13 trillion that we're working with is still almost double or more than double of what was normally borrowed by government in the pre-pandemic days between FY18 and FY19. So much will depend on how efficiently this gets financed will depend on whether the government can make progress on getting India included in international bond indices and some other extraneous factors.
Okay. Yes, I mean, that is the big manner. RBI will not be there to buy bonds and support the market borrowing, as both of you are pointing out. So will foreigners come to the rescue? Will India be included in the bond index? Aditi Nayar, on that, comparing India to others in the same rating bracket, a fiscal deficit of this order, this magnitude that both of them are talking about, 6.3 is what Soumya is talking about. If you add the state's deficit, it comes to double digit. Do you think foreigners will bite even if we get included? Or will they keep us underweight?
Hi, Sada. So I'm just going to briefly talk about my assumptions, because they're a little different from what Soumya and Abhishek just mentioned. So as a baseline, we are working with the assumption that the LIC funds will come in FY23, not in FY22. Therefore, we're looking at an FY22 fiscal deficit of about 16.6 trillion, which is 7.1% of GDP. And that we expect will come down to about 15.2 trillion next year, which is about 5.8% of GDP. Within this, we are also looking at a slightly more optimistic growth for the tax revenues. We're looking at the total tax revenue growth being closer to our real GDP growth forecast of around 9%, while indirect tax growth will be very low, particularly given the duty relief on the excise side. We do think that a continuation of the kind of K-shaped recovery that we've seen in FY22 means that the formal sector will disproportionately, perform even in FY23, whether or not we have a normal year or another wave of COVID-19. And therefore, in both scenarios, we think that the direct tax growth would continue to be on the higher side. And we're looking at a basic tax revenue growth of around 9% in FY23. So given this, so 5.8% is our baseline assumption for Government of India's fiscal deficit next year. We do think that the state's fiscal deficit will probably top out at 3.5% of GSDP, which is what they're likely to be allowed next year. And the reason for that is that we have GST compensation coming to an end in another less than 6 months. And this is possibly going to put pressure on at least some states in terms of a fiscal adjustment in FY23. So we think that the state fiscal deficit will actually go up from 3.3% of GSDP this year to the cap of 3.5% of GSDP next year. Overall, however, because we do believe that Government of India's fiscal deficit is going to come down, we think that the general government fiscal deficit will consolidate from 10.4% of GDP this year to 9.3% of GDP next year.
Yeah, got that. Aditi, I'll have to stop you there because we have to cover the tax collection figure as well. Soumya, do you think, you said you could even look at a tax revenue collection of about 11% higher. Is that really possible? Because this year there was an advantage of a low base and earnings growth of corporate India has been, what, 35% thereabouts. But next year, when I looked at various brokerages, they're looking at Nifty EPS growth of more like 15 to 18%. Plus, as you pointed out, and Abhishek did, excise duty is not going to be there. So do you think we can go with even 9-10% tax collection growth?
Yeah, no, I think, Lata, that's a very interesting point. But if you are working with a nominal GDP assumption of around 12 to 13%, I think given the buoyancy, even if you look into a buoyancy less than 1, that translates into a growth rate of around 10%. So ideally, the tax revenue projections in the budget could be kept at around 10 to 11%. The catch over here is that, what could be the capital receipts which the government is targeting? So I think that number has been growing exponentially in the last 2-3 years. I think this year the government is going to miss the target by a mile. So ultimately, at the end of the day, it will be a balancing act between tax revenue and the capital receipts assumption, because if there is any shortfall in the tax revenue, which basically if it goes below 10%, that is likely to be offset by a higher budgeted number on the capital receipt side.
Okay.
So this is a complicated thing, but please note that if there is any slippage on these receipts, the expenditure growth rate, which is highly inelastic, and if you look into the 10-year decadal growth rate, that has been about 10%. So any number which is a lower number, the government will find it hard pressed to contain the deficit at this level which we are estimating.
You're saying expenditure will be 10% higher?
Expenditure has to be lower than 10%. Okay. The fiscal deficit has to be contained below 17 lakh crores.
Okay. All right. Got that. Soumya, we have to take a very quick break. Abhishek, Aditi coming back in a jiffy to ask you more questions on the expenditure side.